move on quickly to the next session. As promised, we will now dive into the practical aspects of self-insurance via captives. And for that, we have a very distinguished panels with us here this morning. May I introduce, starting from your extreme left, Mr. Christian Wertli, who is the Head of Innovative Risk Solutions of Swiss Re Corporate Solutions, Mr. Steve Tunstall, General Secretary of PARIMA. We have also Mr. George McGhie, Managing Director of the Asia Pacific Captive Practice of Willis Towers Watson, as well as next to him Mr. Roshan Pereira, Partner Asia Consulting of NMG Consulting. Of course, last but not least, we have our session moderator, Ms. Farah Jaafar-Crossby, CEO of Labuan IBFC Inc. So with that, I'd like to hand the session over to Farah.
Thank you, Aimun. Thank you for staying, everybody. This is going to be quite, I guess, informal, and we would like you to participate. And I know that you've had a nice catch-up with all your friends over coffee. And really what we wanted to do is, before we start, ask the audience, how many of you already have a captive? None. Really? I don't think so. I know quite a few of you that already have a captive. Come on, just raise your hands. It's all right. Nobody will bite you. How many of you are thinking of having a captive? One. Okay. Oh, thank you. Very kind. I can assure you it's more than that, and that's why we keep doing this time and time again. Really, the idea is to generate awareness, to generate understanding that about captives. And before we go to the panel, and I've got a few questions for the gentleman over here, I have a question for you. So could you guys go to your Slidos, please? And I'm a bit, we're doing this as a crowdsourcing because we're coming up with a new piece of research about captives in Asia again, which will probably launch in October sometime, third quarter. And so there are questions up there which should come up soon. So please take your time. Don't worry about time. You've had your refreshments and lunch can wait. No, joking. So what are your reservations about using captives? Because only one person, 3 people put up their hands just now. What are your reservations? You don't think your premiums are large enough, really? Okay, so that's definitely an area we need to address. I think there are more than 6 people in the room, right? Come on, get your phones out. That's interesting. Okay. Yeah? So your decision here, your submission here will determine which of the 4 gentlemen I call on first. You do realize that? So they're all waiting with bated breath to try and understand. Okay? Right. More? I think we're quite more or less there. So I think, George, you've probably pulled the short straw. As the manager, do you have a rule of thumb with regards to how much premiums are large enough to justify using a captive? And maybe, sorry, Chris, you might want to chime in a minute as well. I'll leave it to you. Gentlemen, please.
Okay. I've got a few answers to that question, depending on the audience. And since it's a fairly varied audience, I'll give each of the answers. Firstly, as Veng and Andre explained this morning, and I'm going to talk about a bit this afternoon, captives are not alternatives to the commercial insurance market. A captive is formed to make the process of transferring risk to the insurance market more efficient, but also to make the process of financing retained risk as efficient as possible. And overall, they exist to help the parent group manage risk in order that it can achieve its overall objectives. So the question of how much premium you're spending in the commercial market is kind of a secondary issue. So if we take one of our clients, for example, which is famous worldwide for its use of captive, BP, they don't buy insurance. That's their mantra. We do not buy insurance. We are strong enough and big enough to manage our own risk. So they have a series of captives which they use to provide financing for the risk which they retain. But if you look at their premium volume compared to the size of the organization, it looks pretty small. If we take an organization which is only buying, for example, property liability insurance, just buying very basic insurance, that premium spend might be relatively small. But what are they doing about all of the other risks of doing business that they face that may not be readily insurable in the local market? What about the non-damage business interruption exposures, cyber exposures, environmental risks, a whole range of risks that they may not even have considered and may not even be able to insure in the conventional market. So they don't reflect in their premium volume, but actually in those sort of cases, the low premium volume, in my view, indicates a screaming need for another solution, of which captive might be a key part. So that's answer one.
Really?
Answer two. Answer two is about $1 million. No, the answer two is based on if you have, for example, a property program, and you are specifically looking at using captive in your property program, to set up and run a captive is going to cost you somewhere in the region of $100,000 a year. Somewhere in that region, plus or minus. So if you're going into the captive looking to make savings on a specific program, and you're spending less than around $1 million on that program, it's going to be very hard to generate enough saving to justify the cost of the captive.
Bingo. Okay.
So that's the answer I don't like. I like the first answer.
Of course. So the answer is US million, million US.
Now the answer is all the stuff I said first.
So am I being the typical woman putting words in your mouth? But yeah, okay. Chris, did you want to add to that at all?
I mean, obviously size matters. I mean, the bigger the premium spend, the more you can actually justify the overhead or the setting up cost of a captive. However, captives are set up for risk management purposes. And ultimately, I think that's the main focus, you know. I mean, do you get, with all the benefits we already highlighted before, you get better access to the insurance market, you have more control about your program, you can actually write your own policy wordings, you also get the claims data and the underlying data. Because let's face it, if each business unit buys their own insurance and on a corporate level, you don't know on a corporate level what's actually going on underneath. You lose that data and ultimately then the decision making how to optimize your insurance. And I think, I mean, there are plenty of more reasons why companies are going to set up companies. But again, let's go back to the fundamentals. I mean, captives are about risk management and taking control.
Indeed. And I'm glad you said that, and I'm very glad that the 6% came up as 6%, because it's not a tax evasion, it's not a tax play, as it were. It's a risk management, tool. And the reason I wanted to come up with these questions is because there are two major misconceptions. First of all, your program's not big enough, chances are it is. Secondly, it is not a tax play, right? And that's really the thinking behind this question. So it's done its part. I wanted to ask a little bit also specifically about, you know, if you guys can give some examples, Chris, maybe yourself, about how a company may be able to benefit either from a risk management point of view and then the kind of retained profits that a captive may be able to chalk up.
I'll give you 2 examples. One was for a company here based in Asia. It was basically a telecom company based in Hong Kong. In 2000, mid of 2000s, they actually had a bad loss experience. They had a series of losses. They went to renew their program, realized that premiums go up, and at that point in time, they actually looked for alternative. And the alternative was really to do some sort of self-insurance and set up a captive. They got board approval to do that, and what they decided to actually not only have for the lines of business that burned, which was property BI, but rather they combined 5 lines of businesses into that program. PDBI, general aviation, auto was in it, trade credit, and marine. And they combined those and then basically set up their own insurance program. So what was interesting, they bought, instead of getting insurance now from ground up, which you normally do, they decided to retain $10 million each and every. However, when they looked at it, they actually then were concerned about the sideways exposures, i.e. the chances that various lines get hit at the same time, and then they have a series of losses which then erodes the capital of the captive. So they came to us for aggregate, what we call an aggregate sideways stop loss. I think Gwen probably showed you that example. What was interesting, they bought that solution from us for first a period of 3 years. After the expiry, we looked at it again. They said, okay, we still feel a little bit uncomfortable with that sideways exposure, so they renewed it. And after the 3rd renewal, the risk manager still wanted to renew it. However, then the corporate entity felt they feel now comfortable enough with that risk, so they also managed to build up capital over the years, and they also got more loss data, so they actually felt more comfortable with the risk and then decided to retain now that risk instead of insurance. So their motivation was really, firstly, they couldn't get the cover they wanted, or at least not the cover they wanted at the price they had to pay. And secondly, the data they had and the capital they managed to accumulate. I mean, Jörg was alluding about retaining profits into the company that really then helped them to achieve their goals, which was basically then have a standalone captive insurance company. The other example I quickly want to give you is also a typical one, a pharmaceutical company based in the UK. These guys have really problems to get pharma liability cover for their products. So instead of going to the market, they actually have quite a sizable captive, but the captive then provides this liability cover to the subsidiary, and they self-insure that part. So we help them with the 5-year deal to bring the funds into the captive, act as a buffer fund, and then help them with the so-called blended solution, i.e. combining various lines of businesses over multiple years to retain that risk or self-fund that risk. Interestingly enough, now this year, they also started to include cyber into their program. Again, they struggled to get adequate cover from the commercial insurance market. So instead of doing nothing, they use now the captive to so-called incubate that risk, place it in the captive, write their own policy wording, get the data, and I think eventually, over a number of years, then they will be able to transfer that risk into the insurance market. So on one hand, they had uninsurable risks, which they were managed to insure through the captive. On the other hand, now they have new risks where not enough data are available for commercial insurance to participate in that risk. and they use the captive to incubate that risk. So both examples are actually examples where the company wanted to better manage that risk, so the setting up of the captive or the use of the captive were actually risk management driven.
Yeah, it segues nicely into what I wanted to ask Steve to speak about a little bit. This whole, I mean, where would we be at a conference without discussing the digital world, as it were? And that's your world, Steve. And this whole notion that maybe a captive would be able to kind of manage box standard security risk vis-a-vis cyber, vis-a-vis digital. What are your thoughts on that front? I mean, and how esoteric a risk would a captive be able to take, really?
Maybe I should sort of step back a little bit first
Please.
and explain who I am and why you are
Please
asking me this
excuse me.
question.
Yes, of course.
No problem.
Shall I do that, or you?
No, that's fine. I can
Thank you.
remember some of it. So just so you know, I'm actually a risk manager, so I'm sort of a customer really, or I pretend I am a lot of the time. I was the head of risk for Cathay Pacific, head of risk for Genting Singapore for a while. And basically, I've been involved in captives from the customer side for about 20 years now, and I sit on the boards of several, and I'm looking for more board appointments if you've got one that needs filling.
Nice plug.
But the point I always do is going to all the good things that George said about when you're setting up a captive and what you're looking for and how you should be approaching it. Yes, you should be looking at your total cost of risk in the company, and that speed bump, that barrier to entry is what do I have to spend to set up a captive? And I think George said it very succinctly. It's not the same globally, of course, because we're on a journey of becoming more sophisticated here in Asia. I'm currently helping a company set up a captive in the US, and that's a protected cell captive, specifically for employee benefits, and that's going to cost about 20k a year to run. And that's a big company. It's a big company captive, but because you're sort of piggybacking on other systems and structures, the barrier to entry is much lower. So we need to get there, Asia, because it would be great if we can head in that direction where we've got the opportunity for smaller companies with smaller spends to get over that speed bump. Now, in terms of the question and what should be put in a captive or what shouldn't be put in a captive, so far as I'm concerned, there is nothing that cannot be put in a captive. Literally nothing. If you've got a big issue or a big problem and the insurance market is, let's be generous and say, too old-fashioned to help you solve that problem, solve it yourself. That's what the captive's all about. You talk about technology, you talk about funding and things like that, and I don't know whether you were going to ask this separately, but you told me you were going to ask a question about sort of tech and Bitcoin and stuff and exchanges and things like that, But one of the things that I've just been reading about recently is that Coinbase, which is one of the world's biggest crypto exchanges, they've just set up a captive. Awesome. Well done, guys. So let me just sort of, if you don't know much about that, so Bitcoin, think of Bitcoin like the US dollar, okay? And then there's all these other Bitcoin type things like Ethereum and Litecoin and all the rest of it. Think of them like other currencies. So all those currencies sit in a bank. So a bank for cryptocurrency is called a cryptocurrency exchange. So bank, cryptocurrency exchange, it just holds money. The big difference between cryptocurrency exchanges and banks is that most cryptocurrency exchanges are more stable than most banks, and they have better resources, and they have to hold those resources, otherwise there's no backstop. They have to be careful what they do. So they can't buy insurance, most of these companies, but they have to have a large resource of funds in case something goes wrong. So, captive, perfect for them, because the insurance market, by and large, is not generally ready to support those companies. So yeah, I think Coinbase have done something already, and I've heard that Bitfinex here in Asia are trying to do something as well. So far as I'm concerned, if you've got a big risk, you can work out what the scope of that risk is. You can work out the criteria when you might have a catastrophic event. Then there's no reason why you can't fund that in your captive. Build it in such a way that you can manage your trigger events and get the income that you need if there's no alternative ways of doing it. So yeah, long story short, everything can go in the captive.
Doing the kitchen sink. Chris, you've got something to say?
Yeah, I just want to challenge you a little bit here, Steve. I mean,
This is
if
where the
you,
fun
I mean, on one hand, I understand that these companies actually set up the insurance company to mitigate their own risks. However, if they issue their own insurance policy, do you think that's acceptable to customers or to third parties? That's for me the big question. I mean, it's risk management, I get. However, if they have to evidence insurance to customers, clients, third parties, regulator, then I question whether this self-insurance is actually acceptable. So back to you.
So usability, I guess, yeah.
No, exactly. You can't go. If your regulator has required something to be done, then it has to be done. If the customer expectations are that something has to be done in a certain way, then you fail to meet those at your peril, as any business. Yeah. However, in the case of some of the technology companies that I'm dealing with, they actually don't really trust any of the existing structures anyway. So they're looking for something new, something more creative, and something more secure in their view as well than traditional markets. So that's
well, I think
that's
this is where the two worlds collide. So every time I introduce myself at a digital conference or whatever, they look at me and they go, "Oh, you're from legacy finance," and then they just go like that. They roll their eyes. So yeah, I think it's a question of ethos, question of philosophy, and it's a bigger piece than what we're here to discuss. But I want to also ask Roshan about, you know, when you do help your clients set up captives and do the feasibility study and stuff like that, are they very focused on the kind of risk that they want to dump into the captive, as it were, or are they more focused on reducing the cost? What are the main drivers, do you think?
Okay, so first of all, thank you for having me here. So I represent an actuarial firm, and Farah, as you've said, our focus is around, well, two areas really. Is one at that kind of inception feasibility study, will it fly? And then once it's set up, you know, doing the financial reporting. So when doing the feasibility study, we would look at obviously claims experience, indicative pricing of insurance and reinsurance, and then capital modeling, and ultimately the ultimate aim of that is for the captive to be a risk management platform. So yes, risk or minimizing the cover of cost is a key driver, but there are lots of other drivers as well. And these were discussed earlier this morning, right? Access to reinsurance markets, controlling global programs, et cetera, et cetera. When we look at it, we try to focus more on optimizing total cost of risk. So if you think about it in terms of your retained losses, your cost of loss prevention, your insurance costs, you know, taxes or levies on premiums, tax, and uninsurable losses, that's your total cost of risk. And what we try to do is try to optimize that, and then the captive becomes a vehicle for a company to manage that. So it's not a short-term savings vehicle. It's you know, I think it's generally accepted that it's long-term in nature. So you know, there are a lot of moving parts, and they vary from company to company depending on the complexity of the underlying business. But practically, so the experience that I've had is that it's kind of, so it's not a case that a company has done this complete review of their business, right? They haven't done a full enterprise-wide review and said, okay, we really understand what risks to mitigate, what risks to transfer, what risks to... That doesn't happen. It's more, actually in Asia, it's an assertion that a champion would have within a company, and this is typically the insurance buyer, or somebody who's in charge of a global program who would say, well, it actually ticks off some of these like the rules of thumb when you were talking about that. You know, we've got a certain scale, $1 million US, we've got a certain claims experience. We think we can actually run it, we can manage it. So what happens is this individual will typically, the champion will typically get the green light to do a feasibility study, and you do this feasibility study, and then it's a case of actually persuading management to get that buy-in, which is, in my view, is kind of, it's the wrong way around. Yeah, well, I mean, ideally, we talk about the reasons why you would have a captive, and yes, that's all fine, but practically, that's the process that we've seen. And what happens is, you get the green light, you satisfy yourselves that, yes, you can manage, you can minimize your cost of cover, you can minimize volatility, and what they would say was, okay, well, let's set it up and let's put one line of business in. Okay, let's see how, and then let's build it up. And that's where, I guess, structured solutions come into play, where you can say, management don't really understand it. And you saw that in the poll that you just took, right? So you can see that, one of the large issues or the inhibitors is just not understanding this. And that's not a bad thing, right? Because what that forces the management to be at the sharp end of the process, right? To really understand. So when you are dealing with the reinsurers, your risk managers really need to know their stuff when they're going to them and they're presenting these various risks. I'll give you an example. So we were working for a client, Asian client, globally diversified, incredibly complex, who said, right, we want to go along this journey. And we said, okay, well, tell us what your risk exposures are. And that in itself was such a problem for them. They spent ages, they had no idea. And it took a long time for them to understand the shareholding, understand what the exposures were. And this was like 2 lines of business, right? Property business interruption. And trying to catalog that in itself was hugely valuable to them. But they had to go, this was the process that they had to go through. Sorry, so I'm rambling, but to answer your question, it's not. So that's one component, which is a subset of a broader risk management consideration. And what I've seen, at least in my experience, that's the catalyst. It starts there. And then you go on this journey, and then the captive becomes kind of this focus for, hey, look, this is what we can do in risk management, and this is how we can consolidate. And it kind of evolves, and it becomes more sophisticated. So it is a journey that we do see happening, and it is something that is aligned to a maturing, I guess, risk culture in Asia. So,
yeah. So I guess everything in the kitchen sink you can put in it, but you might not want to start that way.
And that's not what happens, right? Ideally, when you look at this and you think, okay, there's so much stuff you can do with this in terms of risk mitigation, but that would assume that you have a risk appetite to start off with, right? And when sometimes you go to boards and say, well, what is your risk appetite? Well, we haven't actually articulated. Yeah. And you need to do quite a lot of work to try and make that explicit and to show them where they're exposed, talk about emerging risks. And it's this education process that is kind of a prerequisite. And it is definitely this kind of journey that you need to go on. Look, I'm not saying this is 100% of the cases. I'm sure that there are companies who are sophisticated enough to go through this process, but the types of companies, or at least the types of work that we've done for feasibility studies, is certainly it's nascent, right? It's really taking people along in that journey because they have a certain assertion or certain ingoing hypotheses around why a captive would work, but that hasn't been fully satisfied, or exactly. So that you go through that process, and that's why you do these feasibility studies. In fact, there are a number of there's like a pre-assessment, right, where you can just you can do a back-of-the-envelope type calculation and say, well, does it no, let's stop, and then you might do that, and then you go, okay, let's go. It's a deeper dive, and that's when you need to understand the reinsurance structures. You need to look at what the pricing might look like, and then it gets quite detailed. And at that stage, you might not even go forward, right, because people go, well, actually, this is far too much. So it's convincing the stakeholders, and unless you have that senior management buy-in from day one, which, like I say, it's seldom that I see that.
Yeah, no, I understand. Are there any questions from the floor? Because Tony Egerton's kind of sat there going, yes, I do, but I'm not going to ask it yet. Yes, please.
Hi, I actually have 4 questions with regards to one topic. So, yeah, maybe each of you can take one. So this morning during the presentation, I think Mr. Martin mentioned about one of the benefits of Captive is that generating revenue stream from third party. So this is a little bit more different than a traditional setup of Captive. So I just would like to understand that further. So first question is that from the regulatory perspective, how exactly does it work? So is it allowable? Is it allowable in Malaysia? And if there's any other jurisdictions that this is not allowed? The second question is that what would be the challenge or a negative impact? Let's say that if a captive company is offering this, so what would be a con if you're looking at pros and cons? The pros is that you're getting money, but what are the cons, the negative impact? The third one is that to what extent is this allowable? So in a sense that, let's say I'm a phone manufacturing company. So do I offer this to a direct customer such as phone warranty, or is it just through my procurement to my vendors that if we are going into this agreement, you need to take this insurance and you can take it with us. So are those the 2 instances? And the fourth one is that can you share if there's any success stories or examples of how it's being done right now? Yeah.
Thank you. Perfect. Absolutely perfect. Gentlemen, who'd like to go first?
Can I jump in on that?
What's your name?
Without, I mean, I've got to be careful with confidentiality, but we've set up a series of these recently around the world and in Asia specifically. I'm trying to remember all the questions, but the
I can help you.
okay.
So the first question is it allowed? The second question is, what's the impact of a captive vis-a-vis third-party risk? Examples, obviously, and to what extent is this allowable? Yes? Right.
Okay. The answer to each is depends. The way that we've typically set these up is not for the captive to offer insurance to the third party, not offering insurance to the customer. But the prime purpose in each of these cases is for the client to enhance their service and product offering to their customer. So it may be an extended warranty, it may be a service contract, it might be a repair agreement, maybe some sort of indemnity that they're offering. So that is offered by the client to the customer, not as an insurance. There are a number of reasons for that. Primarily for for somebody to offer an insurance to a customer, they need to be licensed and regulated as an insurer or an insurance agent or an insurance broker in all the territories in which they're offering that insurance. And that's extremely difficult and can be very expensive to do and to manage. So don't do it as an insurance, offer it as an inclusion with the product. Part of the price for the product then includes the cost of providing that service, and that may either be an option for the client, for the customer, or it may be an inclusion within the price of the product. That element of the price is then identified as a risk provision that the provider then holds to pay for cost of providing services under the cover he's providing to his customers. It's not insurance cover, the cover. That provision may then be paid as a premium to a captive to cover that risk. So the client is saying, I've got a risk, I've assumed it under these agreements, I could fund it on balance sheet, or I could pay a premium to a captive to hold that risk for me. Captive then holds that risk. That risk may then be reinsured into the market as on an aggregate basis usually, because it's usually an ag risk that we're talking about. There was a point there somewhere on the compliance side of things. Usually we would actually have an insurer sit between the captive and the parent to provide a little bit more arm's length to the whole process, particularly the process of the rating of the product. So it gives more evidence of the arm's length nature of that. So that's how we've done them. So they're not, the captive is not offering third-party insurance, and the client is not offering insurance to its customers. So there's not a regulatory issue around that. Sorry, I hijacked that answer.
No, that was very clear. Chris, did you want to say something about this?
Yeah, I want to go early because then I can address the easier part of the question, actually. So I leave the difficult parts to my colleagues. No, joking aside, I think that's definitely not mainstream, that the captive actually writes third-party risk. I think that's rather the exemption than the rule. I mean, the issue really is you're not just taking on premiums, you actually take on risks. And you actually change the brief of your company. Instead of being a construction or mining or manufacturing, you're actually then a risk taker. Obviously, I mean, if you're lucky, you can lay the risks off to the reinsurance market and get a margin. However, in general, I mean, we would probably not advise to write third-party risk. Also, and we briefly talked about it, you always have to have an exit strategy. You can actually relatively easy dissolve a captive if you only write in-house risks, because then your insurance partner, so the insured actually can agree that you either novate the risk or discontinue the insurance. However, if you have a third party underwritten, then you have a promise there to basically cover those risks. So I think you have to be very mindful. That probably goes to my colleagues more on the consultancy side, whether or not that's actually wise strategy, or whether you actually resist the temptation to generate more profit by really rethinking what you take on, and whether you bite actually more than you can chew.
So that's why we structure it as a first-party product, so that there's no, the risk is risk that the parent group is taking in providing their product to their customers. They're not issuing a separate insurance to the customer. They're not engaged in selling insurance to the customer. It's a risk that they've chosen to take to enhance their service offering to their customers, and then they are insuring their potential cost of meeting that obligation through the captive. So it's a
which
first
makes
party.
Perfectly sense, because then you actually basically provide enhanced services with your products. So you actually have a competitive advantage with your products because you also provide this insurance element to it. That makes perfect sense. However, if the objective is to write third-party risk, use the captive as a potential income stream and a profit center, then I think you have to be very, very careful about that.
So just to add, I mean, I agree with what you've said. Where I've heard about, or when people have cited third-party risks being included, the perspective is around diversification. So sort of suggesting that if you're highly focused or concentrated, then it's possible to write third-party risks to diversify the portfolio. But you know, if you're going to do that, you really need to understand what you're doing. And you know, I agree. I don't think it's a wise route. I did have a question, George, when you were describing that. Have you come across IFRS 17? Have you considered IFRS 17 impacts on the captives, and especially when you're talking about you know, the services that have been provided, or the risks that have been covered, because that's something that I've not really heard much about. And and I mean, it's a big thing, because obviously if a jurisdiction is going to be IFRS 17 compliant, Malaysia is going to be word for word compliant, then there's potentially going to be an impact, right? Is that something that's on your radar?
It is. I don't have an answer for that immediately, but again, the issue is that again, it's an insurance product which is provided by the captive to the parent in respect of a specific first-party risk. So it's in the same category as any other class of risk, which is not insurable in the conventional market. Although in this case, as I say, we actually do have a commercial insurer issuing the policy in the first place, and we're then reinsuring that commercial insurer. So it's accounted for in exactly the same way as any other form of risk. The class of risk doesn't affect the the recognition of the income in the captive.
So is it correct to surmise from a lay person's point of view that it's called third party, but actually it's a little bit related? Second party, well, there you go.
That's based entirely on the example that you gave around phone manufacturers, warranties, etc.
Yes.
If we're talking about actually
Pure.
captives trying to get in to
To
compete in the commercial insurance reinsurance world, then no, that's madness.
And to be honest, you'll be hard pressed to find a jurisdiction that will allow that as well. Yeah. Okay. I mean, it's just not structured that way. You know. I mean, it's just not. We as a jurisdiction also have risks to think about. No. Everybody does. Are there any other questions? Yes. Nadika.
I'd like to have a question on EB captive. It's presuming we have a client whereby the loss ratio for the past 5 years has exceeded 100%. So how can we do an effective captive whereby we can actually transfer this risk, taking account medical inflation, chronic illness, aging population, or should they just continue transferring the risk to underwriters?
Sorry, because it took me about 2 weeks to know less. EB is employee benefit. Okay, so it's employee benefit from a corporate entity being put into a captive. Gentlemen, who would like to take this question?
They need to sort out their risk management first, basically. There's no silver bullets if you're not managing your risks properly, and that sounds like their fundamental problem here. If they can work out a strategy over a period of time where they're going to say to their insurers, look, we've been bad, we know we've been bad, this is what we're going to do to make it better over this period of time, and come up with a 5 or 10 point list of things they're going to do, and then have a conversation with the insurers and say, okay, we've been on whatever the deductible's been, it's been quite low. Where would you like to see us taking the first level of pain so that you can then give us a more helpful pricing structure in the future? Then you can start to have a conversation about whether that should be in a captive or whether it should just be a large deductible or whether there's some alternative structure there. But I think there is this sort of presumption amongst companies, oops, my insurance is going up, let's have a captive, that'll solve the problem. It don't work like that. So I think it needs to be a more in-depth review of what's going wrong. Why are they blowing out their policy every year, and how are they going to change themselves if they expect to engage more effectively with the insurance industry? I think it's that bigger point is what I would raise first.
I don't know, employ healthier people. Are there any other questions? Yes?
Hi, Zach Peaster from Intrepid Ventures, and this is really more for Steve. A little bit more broadly around how is emerging technologies, so you mentioned blockchain and crypto, but artificial intelligence, analytics, machine learning, how is that affecting and impacting how organizations are assessing risk, and then how does that translate into the captive market in terms of accelerating adoption of captives, particularly here in region?
It's a great question, and I'd love to be able to give you a detailed, articulated answer as to how that's moving on at great speed, but it isn't, so far as I can see. I haven't seen yet, and I'm not the best person to comment in detail on the insurance industry generally, but I'm not seeing vast changes in the way insurance underwriters behave yet through the use of machine learning, AI, trying to take the knowledge of what's happening in across a broader history. I'm still seeing a lot of insurers, and I deal with this all the time because I run a tech company in this space as well. I still see a lot of insurance underwriters sticking to the old tried and tested models, and if they happen to be on Excel, all the better. And I'm being rude for the sake of it. So that idea that we can take the huge amount of data sets and data points that we're building now globally and turning them into more efficient and better insurance products, first of all, I'm not seeing that going very fast. I'd love to see it going faster. I'm sure there's huge amounts that can be done in that space. And if it is being done, then it's my ignorance. I haven't seen that. I'm seeing exactly the same issue for customers as well. From a risk management perspective, people know there's a lot more data out there. They're just not they're grappling as risk managers. How do I gather that? How do I harness that? How do I use those data points so that I can really understand more clearly what is my total cost of risk for the business and then allocate accordingly? And I don't think it's particularly an Asia-Pacific issue. I think it's a global issue. I'm not seeing companies globally grappling with this clearly, with some exceptions. And the some exceptions, which we could have a whole conference about them, are mostly the ones I've seen in China. So if you look at what's happening with Zhong'an and Alibaba, the way they're approaching some of this stuff, the way they're fundamentally turning their underwriting models upside down and doing things in a different way, then that's the future. But these are one-off examples. I'm not seeing systematic change in the industry, but of course, if anybody is, please, happy to share now or later, and I'd love to be educated.
Roshan, you have something to say about this?
So I think I can comment on the insurance industry, less so about how that's flowing through to the captives, but the insurance value chain is getting disrupted at varying degrees and varying paces through the use of technology, right? So you can see that quite a lot of the focus has been around customer acquisition, right? So portals, apps, the rest. But what you are seeing now is that the back office or the mid office is also being disrupted as well. Examples around claims settlement, automated AI, the use of AI in claims settlement. So we've done a global, we do this annual global study on reinsurance purchasing, and as part of this study we get to see how different forces play out in markets. And you're quite right, if you look at, if you think about it in terms of, say, technology, pricing, capital, business transformation and regulation, how these forces actually play out in different markets in Asia varies quite significantly. So you'll have cat-prone markets, that's top of the mind. But in China, for example, it is absolutely technology and technological development. But there's this sort of perfect storm that's brewing. There is going to be, you can see these things converging, and you can see that there is this change coming. I was at a conference in Thailand a couple of weeks ago, which is all around innovation in motor insurance, right? And you're talking about the use of telematics devices in vehicles. That is really, it's changing the landscape. But seeing that come through, yes, we haven't seen much of it yet, but I think that it is going to be this perfect storm, and then obviously that's going to flow through into other risk management vehicles.
Thank you. Are there any other questions? No? Yes? No? Oh, Nadika. Tony, please.
Just because you asked, Farah. A couple of quick points. I think we need to be entirely clear that Labuan does not allow captives to write pure third-party business.
Yes.
So if there's any misunderstanding about that, I'm not talking on behalf of the regulator, but that's my very clear understanding. In terms of EB, Steve, you're absolutely right. They've got to get the risk management under control. But assuming they do, surely the role of the captive in particular, and Christian might like to comment on this, is to access some of those reinsurance products that we were talking about earlier that makes the whole process much more efficient. I'm talking about aggregate stop losses, and I've seen EB programs in Malaysia in particular blowing completely absolutely out of control by any international standards. They've got to get the risk management right, but then I think we need some of the technology that your colleagues were talking about earlier, Christian, to deal with those. Okay. In terms of technology, what is happening is that we're definitely well away from Excel spreadsheets, and we need to be. because the data sizes are so big that we need new data tools to investigate, to analyze, and to crystallize that information into usable information, all right? And that's definitely happening, Roshan, you see that. I get delivered data where an Excel spreadsheet, particularly on the EB side, cannot cope. They max out in terms of the number of rows. Excel spreadsheets run out of memory on any kind of reasonable sized computer, okay? So we need these new programming languages that allow us to analyze the data. But it's definitely happening. I mean, clearly it is. Even we're using. Sorry.
Thank
Just
you.
some comments.
Anybody want to pick up from that, or are we happy? Yeah?
Just that, yes, it is happening, and yes, it's changing, but not fast enough and not consistently. I'm still dealing with some of the world's largest insurers through my tech platform, and when we try and build an API to connect to their systems, we're dealing with 1975 vintage software, okay? And that hasn't had to change because it hasn't had to change until now. But you're all absolutely right. There's critical things happening now that are really going to make some of this stuff blow up. So it is reaching crisis point, that's for sure. But it's a very patchy landscape. Let's say that.
Do we have any other questions? Yes?
I think a few people mentioned about captive being used for cyber risk. So my question is that how is it different than buying a cyber risk policy? So let's say that I think another benefit is that we have direct access to reinsurance market, but if you already have an RI brokers, so how different are those? Sorry, it might sound stupid. Like
for me, the big question is actually, can you get the cyber policy you want? And if the answer is no, then the question is, what are the alternatives? And we see a lot of, not a lot, we see a lot of companies who actually deal with that question or ask themselves the question, and the answer to deal it is to write it through the captive, because the captive can then provide the policy wording to their respective business units they want, and actually protect them and use the captive and incubator. It basically uses the first party risk. It doesn't address the third party liability risk you might face.
No, absolutely. I mean, there isn't a sort of one-size-fits-all cyber cover out there that will meet all clients' needs. You can't go out and buy it off the shelf, so you have to start with analysing, assessing your own exposure, addressing what your own risk finance needs are. Captive is a perfect home for recognising and financing that, and then access the market capacity that's available to meet your needs as far as you possibly can as a reinsurance of the captive is the way that we would use captive in cyber.
So really it's no different from any other form of risk in that sense, so yeah. Are there any other questions? Yes, sorry.
In a situation whereby an organization cannot manage its own risk, based on trending seasonal report from the previous year to present, and they experience that paying insurance is not better for them than to go on captive. Going on captive for 2-3 years, they still run on loss. Are you saying the company should write off and diversify to another business, or they continue? Because we are, especially maybe as a result of the environment at which they find themselves, they may not even manage either customer or the staff. What will you recommend for this organization? That is one. Two is that with the global issue of cybercrime, the likes of Lazada and so many logistic companies doing online business, virtually one way or the other, they are experiencing cybercrime. What do you think they could do in a situation whereby they set aside a fund and they don't even know how luggage is missing or how funding is missing. Because when you talk about data, most of us, we think of the data they kept within their organization or within their software. But there are some certain moving data. In a situation whereby I send a report to them and it's missing, whereby such report is being hijacked or hacked on the way. And when the report failed to get to them and it cost me much, they could deny, I could deny. What is your recommendation on it? I think it's 2 questions. The second one is cybercrime. The first one is ability to manage their loss. Thank you.
Loss management ability within a captive. So is that just management? Is that just risk management, really, at the core? And the captive is just a tool? I mean, you know, it's quite wide a question. But yeah, Steve, are you looking to take it?
Yeah, I'll take some of that, no problem.
Okay.
I think you were saying in your first question that they're looking at 2-3 years and then change their minds. I mean, one of the key things with a captive is this has got to be a long-term decision. It's not something where you can sort of try it for a little bit and then don't like it and then go off again. It's that shouldn't, you know, not for sort of fickle reasons. It has to be really a strategic change in the way you're approaching managing risk. Having said that, I've had some interesting experiences with other captive board members where a captive experiences losses and everyone goes, oh, that's terrible, we've had losses. And I'm going, no, that's actually quite a good thing, because what that means is you're not going to have a massive hike in your insurance premiums next year. That's why we have the captive. So understanding the logic of what you're doing, why you're putting that risk in the captive instead of placing it in third-party markets, that's really important to determining how that strategy plays out over time. I think in terms of the cybercrime thing, it really builds on what's already been said by the others. You know, I mean, at the end of the day, the reason people are still putting, you know, are looking at cyber through the captive is that, so far as I'm aware, I still can't walk out and buy an all-risk cyber policy. If I could buy an all-risk cyber policy, then I wouldn't be so desperate to put stuff in captives. But I can't. I can buy some selected, targeted things through third parties if I'm to satisfy the board that we're covering this area properly. Then the rest has to be covered through alternative means in a simple way. I don't think that matters whether it's Lazard or whoever it is. If you're exposed to those things, you have to think how you're going to say to your management, we're managing this as best we can.
Thank you. We've kept you almost 10 minutes from your lunch. So thank you, panelists. I think we had a nice chat. I hope everyone else enjoyed it as well. I'm sure they'll be happy to speak to you offline with any specific queries you may have. So all that's left for me is to thank you for your presence today, and we look forward to seeing you at the masterclass after lunch. Thank you very much.
Thank you.